Okay, exercise 4-7. James House is planning on starting a cleaning services business, but has not decided whether he should focus on residential clients or commercial clients. His estimates of revenue, variable expenses, and fixed expenses are shown below. So we have it here for residential and commercial. Part 1. At what volume of hours per month will James be indifferent between focusing on residential versus commercial clients? Okay, that is going to be where the contribution margin, so the formula, contribution margin per hour times the quantity, less the fixed costs of the one, which is going to be residential, is equal to the contribution margin per hour from the less the fixed costs of the other one. We want them both to be equal. So, and I'm looking here, so it's residential contribution margin per hour times quantity minus the fixed cost. Here it should be residential commercial contribution margin per hour times quantity. That's not in there, so that should be in there, times quantity equals, what did I do? Less the fixed expenses. Trying to go ahead and fix that there for you so it's on the screen, but every time I make a change my word freezes up, so let's not do that right now. So for residential, we were given revenue $25 per hour, the variable expenses $15 per hour. Therefore, our contribution margin is 25 minus 15, which is 10, times the quantity minus the fixed costs of 500, and we want that to be equal to, under the commercial, which is 35 revenue, 20 variable expenses. So 35 minus 20 gives us a contribution margin of $15 times the quantity minus the fixed expenses of $825. So if you continue this and work it out, you will get a quantity of 65 hours. So at 65 hours, it won't matter to James which one. He would be just as happy doing residential as he would be doing commercial. Now, Part 2. Calculate the number of break-even hours for residential clients and for commercial clients. Slide down. Okay. Break-even hours for residential clients, you're going to take your fixed expenses divided by the contribution margin per unit. So fixed expenses were 500 and the contribution margin per unit was the 25 minus the 15, which was 10. So 50 hours. So at 50 hours doing residential work, you would break even. Commercial clients, same thing, fixed expenses, which were given at $825, divided by the contribution margin per unit, and that was 15 because it was a 35 minus the 20. So for commercial clients, it would have to be 55 hours before he broke even. And then we look at Part 3. Assume that James decides to focus on commercial clients. So we're only going to look at the one option now. And his business is operating at $120 hours per month. Calculate the margin of safety both in dollars and as a percentage of sales. So his revenue at 120 hours per month. His revenue here, $35 because he's only doing commercial. So $35 at 120 hours would give him $4,200 in revenue. We already know here his break even for commercial was 55 hours. So at 55 hours times $35 per hour, it would be $1,925. So his margin of safety is $2,275. And that is basically how much more revenue he's making than what he would need to make at the break even, or the number of hours he would need to work at break even would give him this much. And the with the budgeted one he's expecting is 4,200. So the margin of safety, 2275. And we also had to do it, this was in dollars, we also had to do it in a percentage. And that is your margin of safety in dollars, which we calculated above here, and you divide it by sales, which was 4,200. So his margin of safety as a percentage of sales is 54.2%. That just kind of tells him how much sales could be different from what he budgeted and still break even. Okay, that's it for that question.